Good morning, good afternoon, good evening. Welcome to Late Night Learning. I am your host, Dr. Anthony Palomba. Now, today we're going to be talking about media finance and mergers and acquisitions. This is a very heady topic and something that is very complex. But before we do that, I do want to mention a few things about today. Today, as we are broadcasting, recording this particular lecture, it is 9/11. It is 9/11, and it's important to take a pause, I think, sometimes in life to kind of reflect upon moments that, have kind of irreparably changed life and society. And I can recall being in my freshman art class, actually, in high school, and hearing over the PA system that a building had been struck by a plane. And some of the students, as you might imagine, laughed because it sounds so fantastical and so weird and so strange. That's ridiculous. And, what idiot flew the plane into the building? And I heard those comments, and I didn't necessarily really laugh. I was a little bit more worried and a little bit more terrified. But it was something that didn't sound real. And it was something that you might have seen in a movie, you might have seen in a show, but it was not something that was tangible. And after the period, I can remember going to my history teacher's class, and he was from Staten Island. He was a New Yorker, and he loved history and was animated and passionate and really into history. Mr. Sheehan, he was really great. And I can remember going into his classroom and the TV set being on, and him just sitting at a desk with his mouth open. Dress shirt, tie, pants, everything else was okay. But he didn't say hi to us. He didn't acknowledge us. And that's when I really felt it in the pit of my stomach. I knew that this was something that was absolutely unprecedented and would make great changes to our world. I think we live in a world in which there's a lot of instability, and I think 9/11 really opened our eyes to the amount of instability out there. We had been lucky to be insulated from that for so long. And I think 9/11 has also forced us to recognize that there are certain privileges and freedoms that we enjoy here that a lot of people don't. And we have to be mindful of that. It's nothing short of a small miracle that you are here listening to my lecture right now. That, from what I gather, you don't have to worry about other people censoring you. You don't have to worry about other people stopping you from learning from this particular lecture. You have the freedom to comment on this lecture. You have the freedom to voice your opinion about other things that you think, believe, and feel, and invest in. And those particular truths and principles are what this country is founded on. And so we're very lucky to be here. I didn't lose anybody in 9/11, and if any of you have lost anybody in 9/11, my condolences. But I did have friends who lost family members in 9/11 and in that particular tragedy. And it's important to kind of take a pause and to really think about and reflect about how lucky we are to be doing what we do today. With all of that being said about 9/11 and remembering the victims and remembering how lucky we are, let's get started with lecture today. The first slide that I have here are some key terms to kind of talk to you about finance. And so, for one, it's important to recognize a few terms that we will be using during this particular lecture. I do this because I want to send a foundation for all of you with finance. I know finance is weird. I know mathematics can be terrifying, but if we break it down slowly, you'll get a better sense of what we're referring to during the course of this lecture. And so for one, we have gross revenue. Gross revenue is the sum of revenue prior to any deductions. So when we think of finance, we think of cash coming in to a film studio, cash leaving a film studio, loans being taken out by a film studio for equipment or to build a new set or to build a new building. This is where finance plays a key role in running a media organization. And so gross revenue means the sum of revenue prior to any deductions. We earned $100 million at Universal Studios, gross revenue, over the weekend for the latest and greatest Fast and the Furious installation. I haven't paid anyone. I haven't paid any taxes yet. I haven't done anything yet. That is what gross revenue is for. That is what gross revenue is for. Second, we have net revenue here. Gross revenue minus costs, including return goods and sales discount. And so net revenue is what we are left with after costs. Now, gross revenue is important to pay attention to because you need to know how much money is actually coming in to your particular firm, and then net revenue after deductions, after costs have been dealt with. What are you left over with? Cost of revenue includes costs and marketing and selling activities. If we think about the cost of accruing revenue, right? It costs money to get someone to sit down to watch a television show. It costs money to convince someone to go to the movie theater, to go see Fast and the Furious 12 at this point. Additionally, what we should also recognize is that any entertainment firm, be it television, be it radio, be it gaming, be it film, have assets. And assets are particularly unique in the media and entertainment industry. First, we do have fixed assets. Fixed assets are fixed. They don't vary. The camera that you have that costs $1,000 will cost $1,000. It can't be converted into cash quickly. It is physical. So fixed assets typically are physical pieces of property. They are physical pieces of property. So it could be equipment, like I mentioned earlier, cameras, could be studios, could be software. It can't be converted into cash quickly, right? Differently, and this is so crucial to the entertainment and media industries, are the intangible assets. These are your creatives' works. They are their crafts, the artifacts that the hired artists have created. This includes patents. It may include trademarks, copyrights, goodwill, and any prepaid expenses. And so intangible assets, for the purposes of this lecture, I'd like to focus on patents, trademarks, and copyrights, right? It's the art that we've built. It's drawing Mickey Mouse and incorporating him into a film. It's creating characters. It's creating storylines and exploiting them for monetary gain, which is what a film studio does, which is what a TV studio does, which is what a gaming studio does as well, right? All of these firms are very much focused on gaining artistic talent to produce artistic works to exploit them. And I know the word exploit and exploitative has a pejorative or negative connotation, but really that is the proper term. They are looking to exploit or capitalize on said property. And so bear that in mind as we move along in this lecture. Let's go to the next slide. Key performance indicators for firms. So before we go through all of these terms, key performance indicators, again, are the key indicators, the key measurements to know how is a firm doing? How is a firm doing? How are they doing? And so it is important to know key performance indicators here. So there are a few here that we will be delving into further during lecture. First, there's depreciation. Depreciation occurs in tangible assets. It occurs in fixed assets. Okay, remember that $1,000 camera I talked to you about earlier. Next year, will it be worth $1,000? No, it might be worth $800 and really it may even have a busted button, right? There might be something wrong with the equipment, or maybe a better camera comes out. And so when we think about decline in tangible asset value, the camera just becomes less worthy. It has less value, if you will, over time. Now, this happens with a lot of things that we purchase in life, right? If we think of cars, the Honda Civic that you're driving right now will not be worth $20,000 in 5 years. It just won't. Houses are kind of interesting because houses tend to go up in value as opposed to a lot of other goods and services that we purchase in society. But depreciation means we decline, right? The physical value of a camera or a studio may decline over time, and that's why repairs and other new equipment are regularly brought in. Amortization, the second term here. This is similar to depreciation, but it is meant to discuss spreading costs of intangible assets over time, which may be exploited. So if we spread out the costs of exploiting Mickey Mouse over time, well, then it works for Disney now, doesn't it? If we think of movies Mickey Mouse has been in, which primarily were in the 70s, 80s, and 90s, that you may remember. He was featured in more movies in the 20s, 30s, and 40s. It costs money for Mickey Mouse to star in a movie, right? It costs money to create it. It costs money to market it. And so over time, we have to spread out the costs of placing in this intangible asset, which is really what Mickey Mouse is, right? Mickey Mouse is a copywritten work. It is owned by Disney. He is owned by Disney. And so it costs a lot to maintain him and to use him in theme parks, in movies, and in television shows. And so that is what amortization regards here. Net income are the profits, specifically, are the profits that are earned by a media firm. Net income is crucial here to follow. Additionally, we have some other key performance indicators here. We have shareholder stock price. Share price maximization here is what the goal of the firm is. Now, when we look at a stock price is what it costs to have a share, a small proportion of ownership over a company. As I speak to you right now, I have stocks in Nintendo and a few other places. And so, yes, I am a minority owner of Nintendo. I only have 2 shares of Nintendo. It's not really a lot, but it does mean that I have some sort of partial ownership, although it is very, 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 very small. So a company works to ensure that value is created for shareholders. And as we alluded to earlier in one of our last lectures, really since the 1980s, shareholder prices are tied and have been tied to CEO pay. This used to not be the case in the 50s, 60s, and 70s. But really since the 1980s, that is how CEOs have been compensated. If we look at Bob Iger of Disney, he is absolutely compensated based on his stocks. If we look at Brian Roberts of Comcast, CEO of Comcast, NBC Universal, he is absolutely compensated by stock price of that particular media conglomerate. And so it is important for CEOs to drive up stock prices in media firms. And that really does explain a lot of media behavior, why we see the same movies being put out. Granted, people come to them and people do watch sequels, although this year has been particularly difficult on sequels. And we also have a lot of layoffs and turnover and merging of departments in media. We've had research teams laid off at Viacom and merged together. At one point at NBC, Bravo had a research team and Oxygen had a research team. In the last 5 years, there have been some layoffs and some reshuffling. They've been put together. Why? Because layoffs can help a firm save money and help drive up the value of the firm itself. And so this is one way to kind of explain a lot of media behavior and why firms do what they do. Why are there so many mergers? Why do media firms lay off people? Why do media continue to perpetuate the same kind of intellectual property? Why do we keep seeing Indiana Jones revivals and Fast and the Furious installations and other franchises that keep being churned out over and over again? Finally, the last key performance indicator for firms here is cash flow. Cash flow is the amount of cash that comes in and leaves a firm. It really is a key for operational health here, and it does impact stock prices. And so for one of the reasons why Netflix continues to be a behemoth, even though it continues to accrue an inordinate amount of debt, is because it continues to have subscribers. It continues to show increases in subscribers. And because it's able to do that, it can show a good cash flow, a positive cash flow, even though it is spending way, way more than it's taking in. Because Netflix can still show a cash flow moving along, this allows it to continue to be an interesting company for investors to look at. Let's move along. Media assets. Media assets, as we stated earlier, involve in particular intellectual property, licenses, trademarks, and other tangible assets. So intellectual property is any kind of artistic or creative work, right? If you've written a book, if you've created a song, if you've written a play, if you've created a TV show, if you've created a video game, those are examples of intellectual property. We also here have licenses. So currently, Netflix has paid for a license to exhibit The Office on it because The Office is owned by NBC, as we know. Warner Brothers owns Friends. And so Netflix has also paid a license or a license fee to be able to exhibit and make available Friends. Trademarks are identifiable logos. And so a trademark is the Starbucks logo, right? That is a trademark that is protected. McDonald's has a trademark, right? The golden arches, the golden M. So it's any kind of logo or symbol that represents distinctly a particular company. And a company can reapply for that in perpetuity. And so trademarks, all they need to do is be renewed, and that's about it. With intellectual property eventually can fall into the public domain. Public domain means that anybody can use said work. This is why people can sing Happy Birthday. That was a song that was written decades ago, and yes, that particular writer could charge people for singing it. But at this point, it's in the public domain. So is Frankenstein. So is Charles Dickens' A Christmas Carol. That's why any studio under the sun can do it, and can really do it on the cheap, because you don't really have to pay anyone. It is now available to the public. The rationale behind that is the artist should be able to exploit a piece of property. If I write a book about a character named Aldo and he's a wizard, I should be able to monetize that because I created it. But after my lifetime and after Aldo has been exploited during my life and I've made my millions, it should be given back to the public because artworks are relied upon to push and inspire people. And so that's kind of the rationale behind why properties become available to the public after really the life of the artist, usually. And so because the media and entertainment industries are so strange and we rely on artistic works, we have to figure out different kinds of valuations for media companies. And there are a few different indicators that we are typically interested in mapping out. And so media companies tend to be fixated on operating ratios and operation cash flow margins. So that's EBITDA divided by revenues, and we'll go through that. One, because of consolidation and concentration of ownership, media assets are owned by complex organizations. That's important to note. Viacom and CBS just merged together. Who owns Rugrats? Ooh. If CBS wanted to get back into the Saturday morning cartoons game, which would be dangerous because, frankly, there are so many channels that are fixated on cartoons, it wouldn't really be a smart move. Does CBS now own Rugrats? Do they have access to Rugrats? Does anybody at Nickelodeon, which is owned by Viacom, have any say in what goes on here? Or does it not matter? The complexities are vast and profound, as you can see. The second thing to note here is the volatility in the financial markets has created a moving target for equity valuation. It's very difficult to know how a firm will do year to year in the media and entertainment industries. For firms like Procter & Gamble, Johnson & Johnson, and other consumer good conglomerates, they kind of know what will happen, right? They know X amount of bottles of shampoo will be sold, paper towels, toiletries, things that people need, they're going to need next year. And so the volatility should be reduced. Who here needs another installation of Transformers? Who here needs another installation of Harry Potter? It's not needed, right? If we really, really think about it, it's not needed. And so year to year, as hard as these entertainment firms work to market these particular pieces of intellectual property, it's very difficult to anticipate what will happen. Yes, they can look at previous box office numbers. Yes, they can look at what the actors and actresses and directors and writers implicated have done before to get a sense. But the arts are an inexact, imprecise industry. And so it's as best as we can to predict, and there are modeling techniques and things that you can do, it's extraordinarily difficult to do. 3, technological innovation and convergence are resulting in a new era for both the creation and distribution of media content. What this means is that 15 years ago, we would have to go to Blockbuster to rent out a movie. We know now that things are distributed. We know now that the costs of distribution are being reduced rapidly. And so companies implicated in the distribution of media have to reorganize themselves and think about where they belong in the industry. In particular, in this example, I can call out cable companies and satellite companies. Do we need cable companies or satellite companies? MVPDs, right? Those who distribute content. Now, I'm not talking about Netflix, I'm not talking about Nickelodeon, and I'm not talking about other cable channels. I'm specifically talking about DirecTV, Time Warner, and other systems that we rely on to distribute content. Do we need them anymore? That's a really interesting question. And so when we think about media assets, we're also saying to ourselves, well, things change so rapidly, DirecTV has to rethink its strategy. And we're seeing this through the advent of skinny bundles. All of you listening to this lecture should absolutely know what a skinny bundle is. A skinny bundle in the last 5 years has really hit the marketplace in response to SVOD services to kind of serve as some sort of counterpoint to facing this new age digital streaming service. And so a skinny bundle implicates channels. And so a few years ago, we saw some channels be rebranded. We saw that Spike TV is gone. It is now the Paramount Network. We know Esquire is no longer the case. It has been jettisoned, abandoned from the NBC cable portfolio. And so skinny bundles use 5 to 15 channels in a particular bundle. And so it may be A&E, Disney Channel, ESPN, NBC Bravo. A few select channels are made available to consumers. So it could be, 5 to 10 channels, it could be 10 to 15 channels, and it also could vary on the particular genre, if you will. So there's a sports bundle, and there's a drama bundle, and there's an orange bundle, and a blue bundle if you're using Sling TV. And so all of these bundling techniques have served as a way to make cable distributors and satellite distributors still relevant in 2019. A lot of executives in these firms have realized that none of you really need 100 channels. In fact, none of you need really 75 channels. And really, most of you don't really need more than 50 channels. And so technological innovation and convergence has impacted cable and satellite systems dramatically. And it's important to note this when we think about media assets. Let's move along. The valuation of media assets. It's very difficult to know who is going to take off And I have two of my favorite shows here, and really two of the best shows ever created in the last 30, 35 years or so, is Friends at the top and Seinfeld at the bottom, which is in a particular graffitied, though very artistic looking motif, and so I couldn't help myself but include it here. Most media value is driven by intangible assets. I can't stress that enough for any of you here. Warner Brothers is impressive. I have been fortunate to take tours at Warner Brothers. I have been fortunate to take tours at CBS out in Los Angeles. I have been fortunate to meet all of these impressive executives. But as wonderful as these executives are, and they are very brilliant and they know what they're doing, their value, especially those who are involved in acquisition, is namely that they need to acquire solid, original content that will resonate with a lot of people. This is remarkably difficult to do. So first, there's market valuation. This is the assumption that value of an asset or line of business can be established by comparing it to similar assets or enterprises where a value has been established. This may be based on public market and public data such as mergers, acquisitions, and set sales. So that's another issue when we think about comparing across. Now, Seinfeld is an NBC show. I believe it was taped by Castle Rock Productions, which is a really good company. Friends was filmed at Warner Brothers Studios, although it was distributed by NBC. Can you compare the two? How do you compare the value of one show to another? How do you figure that out? Is it advertising revenue? Is it viewership? Today in 2019, we can measure social media buzz. How do you figure that out? And how do you compare shows? Can you compare shows? Now, back in the 1990s, each show that was on television generally put out 20 to 22 episodes that were a half hour each on the nose. And so there was some standardization for the sitcom and the hour-long police procedural. If we look at Netflix or HBO or any of the other streaming services, the notion of limiting a particular episode to a set 40 or a set 30 has really been abandoned. I watched an episode of Glow on Netflix the other day. It was 37 minutes. I promise you 20 years ago, if I brought that into anyone, they'd be furious. 37 minutes is too long for a half-hour sitcom, and it's too short for an hour-long drama. Usually an hour-long drama is about 40 to 44 minutes. And so that creates further problems when we try to compare across these particular industries. And so this is difficult to do in the media and entertainment industries, as there is such variance in each media company, including comparing all Comcast assets to Disney assets. Additionally, it's difficult to assess the lasting appeal of tangible assets. Who knew Seinfeld and Friends would be mega hits and still be popular after syndication? You don't know. Differently, if we look at other industries, will your house be more valuable in 20 years? Yeah, probably. Are there formulas and set algorithms that we can employ to ensure that's the case? Yes, there certainly are. And so when we think about these particular industries, it's very, very complex, and it's very, very difficult to kind of assess the value of anything here. And that's all the time we have on Late Night Learning. As always, keep laughing and keep learning.